All right. Well, good afternoon, everybody. Thank you for joining us today again. My name is Samir Varma. I'm a partner in Thompson Hine's International Trade Practice Group based here in Washington, D.C. Joining me today are my colleagues Francesca Guerrero and Michelle Lee, also partners in our International Trade Group, both also based in Washington, D.C. Thanks again for joining us today. Wanted to welcome you to today's webinar. This is the 14th in a series of webinars examining the shift in presidential power and what it means for our country. Hard to imagine it's been, I think 120 some odd days since President Trump took office. But obviously that's caused a lot of interesting debate on how it impacts our regulatory areas. And today we wanted to discuss sort of tariff mitigation strategies just amid the shifting trade landscape. Before we begin, I do have to go over a couple housekeeping items. Today's program is being recorded. We will send a link to all the attendees in a few days' time. The presentation is intended for the general information of individuals and organizations on matters of current interest. The thoughts and opinions expressed today are those of the individual panel members, do not necessarily reflect the opinions of Thompson Hine, or any of the panel members' clients, affiliates, etc. This content should not be taken as legal advice. The views expressed here are for informational purposes only. If you have any questions during the webinar, please feel free to use the question box located in the control panel on the right of your screen. We will try to answer the questions as we go. But given the sheer amount of information that the three of us want to go over today, we may not be able to do so. And so what we'll do is we'll take those questions and try to respond after the webinar via email or phone or whatever. CLE credit for today's webinar is pending. Please be sure to complete the verification of attendance survey. That link the link to the survey is posted in the chat right now. We'll also paste the link at the chat at the end of the program, and I will announce the attendance tracking code also at the end of the program at 3 o'clock Eastern. In the handout panel, you can also download a copy of the PowerPoint slides, bios for the three of us, for the speakers. That's all there for you, so you don't have to worry about that in any way. Again, thanks so much for your interest. Again, if you have any questions, please put it in the questions box on the right side, and we'll go ahead and begin. So, as you can see, here are our presenters, myself, Francesca, and Michelle, the three of us down there, the three of us up here. I think it's a little off on my screen, but you can tell who's who. Today's agenda, we're going to try to get through a number of items. We're going to start with just a quick background on the current situation involving tariffs, where we are with the different percentages or the different rates of duty that are applicable to the various countries and various products. Then we'll dive deeper into the more specific tariff mitigation strategies, including valuation options, use of FTAs, FTZs, drawback, and we'll end the discussion on just some high-level discussion on operational restructuring and some contractual considerations that you all should be looking at. I'll start with the background. I'll start here with the background and start off by saying, and I've been saying this a lot to a lot of the clients and companies that we work with. We understand, right? We understand that companies deal with certainty. And obviously in the last 120 days or so, the situation surrounding tariffs has been anything but. It's been uncertain, it's been a bit chaotic, but there's been a lot of back and forth with these percentages. We get it. If the percentages or the rates were set, like it was essentially during Trump's first term, when they're set, companies know how to deal with that set percentage. You can move things in your supply chain. You can look at things a little bit differently because things are going to stay the same. We get chaos, uncertainty, problematic. We don't know how to react. You don't want to put money and resources to a certain change in your supply chain if the tariffs may change just in a few days. And we see that all the time. But the reality is that The tariffs now, in whatever form they're going to be, are going to be there. There is going to be tariffs in place for the vast majority of countries, whether it's 10% or higher. That's the uncertain part, but tariffs are here to stay. Right now, we have the reciprocal tariffs of 10% in place. During that crazy time frame in early April, between April 2nd and April 9th, we understand that there was a lot of different percentages being thrown around by the government. There was movement, there was chaos in the market. The 10% is here now. There is a 90-day pause on potential higher country-specific rates until July 9th. And even in fact, this weekend when we saw President Trump indicate that there may be a 50% EU tariff, that also is sort of paused, he said, until July 9th for now. So right now we have a 10% across the board rate that is for every country other than Canada and Mexico. That 10% is also for China. The China situation was created, the 10% was created after going up and down up to 100 and 34, 100 and whatever it was. Went down to 10% around May 14th. And so the 90-day pause is until August 12th. This does not include Canada and Mexico because Canada and Mexico are still under what's known as the fentanyl border migration tariffs. Just to level set everybody, we have written down IEEPA. That's the International Emergency Economic Powers Act. That is when President Trump declared an emergency as it relates to the global tariffs, as well as the fentanyl and the border migration crisis. Using the IEEPA powers, when you declare an emergency, he could place certain tariffs on the goods coming across the border related from those countries or related because of the fentanyl or border migration crisis.
Samir, I'm going to ask a question that I saw pop up, mostly because I'm very excited to see if the question box works. And we got a question that said, is the 10% reciprocal tariff on top of the MFN duty rates?
Yes. The answer, and good to see the question box working. That was I know that was kind of a concern, but no, it is yes. The answer is yes. We're referring to this, or the industry is referring to this as stacking, and basically the tariffs are stacked on top of each other. And similarly, they aren't stacked on top of the normal MFN duty rate, most favored nation duty rate, which is the standard duty rate that's been in place for forever, right? And similarly, the stacking idea applies for China, for example, because they have the IEEPA reciprocal 10%, and then under the fentanyl border IEEPA tariffs, there's an additional 20%. So for China, it's actually 30%. And then on top of that, you get the Section 301 duties, which are also stacked on top of that. So it's 30% plus 25%, 55%, plus whatever MFN duty rates are in place. So these numbers can go higher and higher and higher. And when we say these are sort of here to stay, they're not going away, there's still a lot of discussion. We know about the steel, aluminum, auto parts. They're at 25% right now. We're still looking at different, there's still reports that are to come out by the Department of Commerce related to other products in pharma or copper or semiconductors or lumber or dairy from Canada or all of that. And so again, these tariffs aren't going away. They're in place right now. And this is just sort of where we are today. Oftentimes we don't, I've said this to other people as well, oftentimes we don't use slides as much, especially these types of slides, because this slide is maybe obsolete within the next couple of weeks. So this is the way it is today. We'll see what happens again in the future.
We got one more question and then we should probably move on. Do you think Commerce will take all 270 days allotted for the 232 investigations that you just mentioned, lumber, et cetera, or will this be expedited, or will this be expedited because of the president's agenda? I think there's no reason that they have to take 270 days, so I don't think that they will, especially if they already have most of the information they want. Some of them are going to be more complicated than others.
Yeah, and I think this is a good place to sort of mention, all of this is subject to the deals, right? The deals that the countries are making with the United States right now. There's many countries are coming to the table. U.S. is negotiating different trade deals with them. You saw the UK deal. There's and in those deals, I think there is discussion about this type of stuff, right? With the 232 investigations related to lumber, to dairy, whatever it is. And so, no, I don't think they have to take the 270 days. It's not it may be sooner than that, and also may be part of whatever trade deal gets put in place between the various countries.
And one, it's also important to note that even once the investigation finishes, the administration doesn't have to take action right away. We have Section 232 tariffs on autos and automotive parts, and that investigation concluded in the last Trump administration, and there are no tariffs imposed until now.
Yeah. So just moving on to some of the general ideas surrounding why tariff mitigation strategies are important. We are seeing an increased focus on customs enforcement. This is something that we've been thinking about a lot over the last few months, and how that's sort of the new area the government is going to focus on. It is coming to fruition right now. We already have seen a lot of commercial problems, delays, detentions, denials of entries at customs. Really what happened is, prior to April 2nd, we knew April 2nd was coming when all the new tariffs would be instituted. We all knew that was referred to as sort of Liberation Day, right? And really, when the tariffs were put in place on April 2nd, stayed and then saying that on April 5th and April 9th there were going to be additional tariffs, there was this savings clause there that said if ships were on the water, they were and entered into the United States prior to, I think it was May 14th at that point, or May 17th, they would not be subject to the tariffs. And so a lot of companies, put ships on the water, started importing things to basically get inventory into the United States to not be subject to those and be subject to lower tariffs, not the April 5th or April 9th tariffs that were put in place. This is causing a major backlog at customs ports, but that backlog has allowed the ability for CBP to do increased checks, increased detentions, increased audits, investigations, requests. We're going to be seeing a lot more requests for information, or CF-28s, that companies are going to be receiving. We already know that negligent entry declaration, as it relates to valuation, to classification, and whatnot, that can lead to a loss of monetary duties and in monetary penalties. Customs has the ability to enforce monetary penalties dependent on the level of culpability, negligence, gross negligence, fraud. They do, if there is a duty loss, they can impose multiples of the amount of duty loss. So not only do you owe the duties, but if in a negligence situation you can own 0.5 or owe 0.5 or 2 times the amount of duty loss. Grossly negligent, 2.5 to 4 times the amount. Fraud, 5 to 8 times the amount of duties that you already owe. But you can also owe duties when in non-duty loss situations, up to 20% for negligence, up to 40% for gross negligence, up to 80% of the value of goods for fraud, and even more, even up to the value of goods. So that's all in play. False Claims Act. We feel we'll be seeing a bit larger increase in False Claims Act litigation. Now, for those of you who don't know, the False Claims Act allows private persons to file suit for violations of the False Claims Act on behalf of the government. And it allows for the private person to receive a certain percentage of the recovered revenue should the government launch an investigation, or even if it doesn't, if it declines to intervene, you can still receive a certain percentage of whatever the revenue is generated from the duty loss. And so that's a whole other area. That's a larger area. I don't want to take too much time on that, but that is something that we're going to be seeing. And one thing we saw recently, on May 12th, just a few weeks ago, the Department of Justice issued a number of updated policy memoranda, including its white collar enforcement plan. Trade crimes, and in particular, trade and customs fraud, including tariff evasion, is now a major focus of the DOJ. It actually ranks second behind only waste, fraud, and abuse of federal programs and procurement fraud. And so the government is signaling that customs fraud, tariff evasion, there is going to be a main focus. They're going to be prosecuting this. And so this is something that we should all really be aware of. And it also includes a whistleblower program to allow private citizens to tell the government when they see instances of customs fraud and other areas. Moving on to evaluation. Yeah.
So we're going to talk about some different ways you can try to mitigate tariff, meaning reduce the cost of tariffs. And at the beginning, we were laying the background. We all know why this is an issue and why people are interested. The moral of the last slide Samir was talking about is really, you need to do this the right way. Everyone wants to mitigate tariffs, and we're going to give you some ideas, but there are many, many ways you can get in trouble doing that. So you need to be careful. And these things I'm going to talk about right now about value, they're all complicated. So we are going to try and give you a high level taste so you can think about whether you want to look into this for your company. Any of these topics could take hours to discuss on their own. So just as kind of background table set, the customs value has precise regulatory requirements. Transaction value is the preferred method. And transaction value means that the price actually paid or payable for merchandise when it is sold for exportation to the United States. We've seen lots of people try to mitigate tariffs with what we would say are risky, not really, questionable methods, double invoicing, rebates, etc., that might be customs fraud. But there are some legitimate ways to reduce the declared customs value. And we're going to talk about some of them. There may be some more. Next slide. So one of the things to think about is what they call first sale. If you recall from the last slide, it said the price paid or payable when sold for exportation to the United States. So under first sale, what they say is, if there is a middleman who is buying something specifically to send it to the United States, to basically resell it to you, importer, then that earlier sale to the middleman could be a sale for exportation to the United States. And that is how you get the idea of first sale. There could be multiple steps even within the chain. I've looked at situations with related parties where they might have they might act as a buying agent for an affiliate, and they might be buying from distributors and manufacturers and sending it to their US-based company. When you have first sale, you need to be careful and look at certain factors, and that's the next slide. First, you need to make sure that you have a bona fide sale. And so that's going to be make sure there's an actual sale where the ownership, the risk of loss is transferred to the middleman and then to the importer. Okay, so it can't just be on paper. It has to be at arm's length. So those of you who are who are used to looking at transaction value and testing whether that's at arm's length, it's a very similar sort of analysis. That the price must be at arm's length. And the item must be intended for exportation to the United States at the time that it is bought from the person that you're trying to use as the transaction price. So for example, if a distributor buys 100 barrels of something, and then you want to buy 2 of them to import to the US, it's pretty hard to demonstrate to customs that those specific 2 barrels were purchased to go to you, and were purchased to go to the United States. But if you place an order from your distributor and then they go buy 2 barrels from the manufacturer to fill your order, that's more likely to be qualified for first sale. So this is an example that's worth looking at. Someone said the price must be at asked a question about the price being at arm's length. It's basically customs analysis where they look at fair market value. If it's a third-party sale, So like the people are unrelated, presumptively it's going to be arm's length fair market value. It's where you've got a related party sale that it's becomes more questionable, and you have to look at whether they have sufficient profit, etc., for the price to be reasonable. Next slide. Here's another interesting thing to think about when you're thinking about value. So again, Tariff Act says that it's the transaction value is the preferred method, and then they have some statutory things that have to be included in the value, in addition to like the price on the purchase order. One of them is royalties or license fees related to the imported merchandise that you're required to pay, buyers required to pay, as a condition of sale of the imported merchandise for exportation to the United States. When you start parsing this, they will say that royalties or fees for patents that covered like the manufacturer of the merchandise is dutiable. So let's say you think you're being clever and you pay one price for the items that you're buying from the manufacturer, but you separately pay them a fee for using their patent, right? So CBP says, no, we're not that dumb. That's included in the price paid or payable. But let's say you are importing an item that, let's say some sort of electronic device that can be utilized for a lot of different software programs. And historically, you're importing it with the software to sell to customers who want to use it for a specific purpose. That's what they want to do, right? But the hardware can be used for a lot of things. Generally speaking, the software license fees don't necessarily need to be included, and it's a complex test. They're not necessarily a condition for the sale of the merchandise. So there are several cases where someone imports the hardware, then loads the software, and so they don't have to declare the value of the software. Again, complex analysis. Make sure you work through this carefully, but that is something to consider if you've got, hardware, software items. Next slide. Okay, and so now we're going to move into free trade agreements and some other topics. I'm just going to talk briefly about free trade agreements. Again, that could be a whole series, but when tariffs start costing real money, people start thinking, oh, maybe my goods qualify under a free trade agreement, right? A lot of items prior to the Trump tariffs were 0%. So people weren't really doing the analysis as to whether they might qualify under USMCA or whether they might qualify under a different free trade agreement. Currently, items that qualify under USMCA are exempt from the IEEPA 25% tariffs on Canada and Mexico. So it's a pretty valuable exemption. So some of the other free trade agreements, by the way, do not exempt you from the reciprocal tariffs. So you need to look carefully when you're doing this analysis as to what tariffs you might be able to get out from under with the free trade agreements. But there is sort of, again, there is value into looking at these free trade agreements. I think next slide, just to talk about how they would work. Most free trade agreements have very strict rules regarding which goods qualify for duty-free treatment. So it's not enough that a good is manufactured in Canada or Mexico or Colombia or Israel. It's not enough that the country of origin from like a substantial transformation point of view is that country. You have to meet the origination rules. So that means that if you're manufacturing something, you need to understand your bill of materials. You'll need to have the classifications of the components and the costs and the origin for those items. Because a lot of the rules, when you start looking at manufactured items, are going to look at tariff shift of the component they might look at the regional value content, so you have to understand the different values. And so it's a complex analysis, but again, it might very much be worth it for your business. And so this is another thing that companies are looking at to mitigate tariffs. I did want to just make that disclaimer. Many of the tariffs say that free trade agreements do not get you out from like the IEEPA reciprocal tariffs, for example. But Canada and Mexico is one of the ones where it's very valuable right now. And I think the next slide is going to be, okay, chapter 98. This is a whole chapter, and I'm just going to highlight a few of the items that I think are interesting in chapter 98. First, I will note that most of the tariffs, the Trump tariffs, do allow use of chapter 98. So while they exclude free trade agreements, and Michelle will talk a little bit about how they play around with foreign trade zones, most of them do permit the use of chapter 98 special classifications. And chapter 98 has a bunch of special classifications that allow a good to be entered either duty-free or a good to be entered under sort of a bifurcated value, where part of it is duty-free and part of it is dutiable. And so an example of something that would be potentially able to be entered duty-free would be something that is sent from the United States, basically in its final form, but needs to be assembled to another country, and it's assembled and then it's returned. And it's not transformed, there's not a tariff shift, etc. That might qualify for certain entries under chapter 98. Another one that we've been looking at lately with a lot of companies is the idea of something being returned after repair or advance in value. So this is one of those ones where they bifurcate the value. So you have an item, let's call it a ship. Well, okay, ships are probably weird. Let's call it an aircraft engine. And it is sent to Mexico or Canada for repair. So under chapter 98, when you bring it back, you would have traditionally you'd have two classifications. You'd have the one for the engine itself with the value that it left the country at, and then you'd have one for the repair, the value of the repair. And duty is assigned on just the value of the repair. There's a really interesting intersection with USMCA because items that are repaired or advanced in value in Canada or Mexico and qualify under chapter 98, they're duty-free, just like USMCA originating goods are duty-free. So again, this is definitely worth looking at, looking at chapter 98 and whether for companies that have complicated manufacturing processes, there's a way you can take advantage of this. And I think I'm going to pass it on to Michelle now.
Thank you, Francesca. Let's dive into the FTZs. A foreign trade zone is a secure area within the U.S. near ports of entry, but treated as outside U.S. custom territory for duty purposes. Now, here's how they work. Duty deferral. No duties are paid until goods enter the U.S. for consumption. Export advantage. Goods exported from FTZs incur no duties. And there is a tariff shift benefit. Manufacturing components in the FTZs can reduce a lot of costs. For example, for goods that are under the non-privileged foreign status, if the finished goods after production in the FTZs have a lower tariff rate than their components, then you pay the duties at the rate of the finished goods. That means you save duties. Plus, no duties apply to scraps or waste. Next slide, please. Now, to add, FTZs allow privileged foreign status for unordered foreign goods, which means the foreign merchandise that has not been manufactured or manipulated for tariff shift in the FTZs. The benefits, so duties for the privileged foreign status goods, the duties will be assessed based on the tariff rate at the time of application for the privileged foreign status. It offers a lot of predictability in volatile trade environments. Now, the benefits of FTZs are somewhat undermined by the executive order on April 2nd, 2025 to some extent, because the executive order state that subject articles of this IEEPA reciprocal tariffs must be admitted into FTZs in privileged foreign status. So Annex 2 of the EL, the executive order, provides a list of exemptions, including the pharma products, agricultural chemicals, and certain electronics, which will still enjoy the default rule, which is the non-privileged foreign status, whereas all other articles subject to the reciprocal tariffs will have to be admitted into FTZs in the privileged foreign status. That means that the articles subject to the reciprocal tariffs will not enjoy the tariff shift benefit. So all the FTZs can consider admitting NS2 or this exempted merchandise in the non-privileged foreign zone status for the FTZ production with the tariff shift, the duty savings as traditionally what you could have done, or you omit all those products, the exempted merchandise in the privileged foreign zone status, which would depend on a lot of a variety of factors and uncertain future to your business. Now, I still think there are a lot of benefits to start or continue FTZ use. The cash flow savings will be extraordinary. The scrap and waste savings, zone-to-zone transfers, the duty avoidance on the exportations, and there might be, you might allow you to weather the tariff like unpredictability a little bit too. Next slide.
Michelle, before we move on, we have a question, and I just wanted to also pick up on something you said. You said for exports, duty avoidance for exports, right? So to be clear, if you import something into a foreign trade zone, you manufacture it into a new product, and then export it without having entered commerce in the United States, do you pay duty?
If
you
omitted those products and then you export them immediately and without entering the U.S. territory at all for consumption, you don't need to pay duties. That continues.
Okay. And then the question was, if we bring in an item to an FTZ and leave it until tariffs change, do we pay the duty based on the day we brought it in or the day we pull it out? Assume we're talking about bringing it into the US for consumption now. So we're not talking about bringing it to the foreign trade zone, maybe doing manufacturing and then exporting. But we're talking about bringing it into the foreign trade zone, parking it, and then bringing it into the US. What's the normal rule and what's the IEEPA rule?
So this is a great question. So it depends on what the item is. If the item is Annex 2 exempted merchandise of the executive order on April 2nd, which means they are not subject to the reciprocal tariffs, then you will follow the traditional rule. You will you can do the production there, and you can pay the duties upon the day that you actually get out of the duty zone for consumption, unless you want to apply for privileged foreign status yourself, which will lock you in the duty rate at the time that you get admitted or at the time of application of the privileged foreign status. Now, this question would not allow you to, if you do the privileged foreign status, which means you are really not applying for any manufacturing, so that doesn't apply to your question, but that's a traditional way. So you do have the freedom to decide what the status of your entry and what the rate you want to pay. Is it the duty at the time that you apply for the privileged foreign status, or the rate that you get out of the duty, the FTZ, and whether you want the rate of the finished goods or not. So, but after April 2nd, if your products are subject to the reciprocal tariffs, basically most of the products other than the one that listed in the Annex 2, then your products will be locked in as the privilege foreign status. So that means that you'll be locked in at the rate of you coming in the FTZ, not the rate that you will get out of the FTZ, because that's pretty much the day you come in, you are already at, privilege foreign status, which is the date of normal application. And so that will hopefully that will answer your question. But only if the duty, you don't need to pay any duties, only if you decided to enter the goods into U.S. territory for consumption. If you want to destroy them, you want to export them right away, you don't need to pay any duties, even though the rate is locked in at the date of you kind of coming in the FTZ. So.
I think, and just a follow-on question, because I know this has come up, and I think you were going to talk about this, but the duties are applied to the products that are, if products come into the FTZ, and let's say they have privileged foreign status, so now you owe the duties upon the date that they come into the FTZ, right? And there's manufacturing done in the FTZ, and the product comes out. Do you have to pay duties on that added value, the added manufacturing, or is it just the products that come in? I think there's, and yeah, go ahead.
I think this is an excellent question. Nobody says that you cannot manufacture products, even if they are subject to the reciprocal tariffs. And there might be, if you have enough the domestic merchandise, because remember, not just the foreign merchandise can be entered into the FTZ. Some domestic component down the street, like say you are a facility in Ohio, you pull a down the street suppliers components in the FTZ and make it a product inside the FTZ, you might be able to qualify for the substantial transformation and make it U.S. origin goods inside the FTZ, even though the foreign merchandise will be continued considered as foreign, but the whole thing might be coming out, you can argue that this is a U.S. origin goods. So that part is something that worth exploring more, even for the merchandise subject to reciprocal tariffs. So let's move on to the next slide for custom bonded warehouses. This facilities let you store the foreign goods for up to 5 years without paying duties until withdrawal. Some key points I want to highlight here is that there are cash flow benefits like FTZs. The duties will be deferred until goods enter U.S. commerce, like for consumption. The limitation is that there is no manufacturer allowed, there's no domestic components allowed, and duties apply even if the goods are damaged or later exported. So to get into the bonded warehouse, you have to file your entry. The duties are owed the day that you got in. You have to pay the duties regardless. So this is a lot different from the FTZ, but this tool is ideal for businesses needed the storage flexibility, but it does require some careful planning. Next slide, please. Now I want to talk about duty drawback programs. Duty drawback programs allow you to recover 99% of duties on imported goods that are later exported or is destroyed. Two key pathways I'd like to highlight today. First is unused merchandise drawback. Unused merchandise drawback is a provision that allows for refunds on imported goods that are unused in the United States prior to their exportation or destruction. Now, there are two types of matching of import and export, which is fascinating here because traditionally you always match the imports and the exports intuitively by direct identification. For example, the lot number on the imported merchandise, and you want to see it on the exported goods as well. Now, but recently there are changes to the drawbacks. So it allows a second type of a matching called unused merchandise substitution drawback, which allows for the recovery of the U.S. import duty when the unused material doesn't matter whether it's imported or exported, as long as it's commercially interchangeable with the import duty paid merchandise, i.e. they are classifiable under the same 8-digit HTS subheading number, then you can get the refunds of the US import duty before their exportation and destruction. So basically, if you have a merchandise that is, you enter into the US from China and is subject to some duties, and you pay those duties, and then you never use them, and then for a portion of it. And then there are other countries, the same HTS code merchandise that you import at a lower duty or whatsoever, or no duty at all. And then you export a bunch of them, and bunch of them include some of those like Chinese origin merchandise. Some of them are domestic merchandise. Some of them are another third country, say Indonesia merchandise. They're all classifiable under the same 8-digit HTS code. Then you can bundle them together and apply for refunds for the unused merchandise drawback. This is allowed under the unused merchandise substitution drawback provision. Now, the second type of drawback I want to talk about is a manufacturing drawback. It's very similar. The only thing different is that we're talking about the imported merchandise or some merchandise that are classified under the same 8-digit HTS number as the imported merchandise. And those merchandise, whether they are coming imported or domestic or anywhere, as long as they are substitutable under the same 8-digit HTS codes, and they are used in the production of the articles that are that later exported or destroyed, then you can apply for the refunds. It allows the importer, exporter, producer, and destroyer to apply for such refunds. It also allows the substitution within the same 8-digit HTS code. To make it simple, it's just basically if you have a bunch of exported and destroyed goods, and the components in it is say you need some certain discs or a certain widget to make the exported or destroyed goods, and whether the widget that you are using in the production of the exported or destroyed goods were imported or domestically, you can bundle them together and ask for the final duty refund. So that allows a good deal of flexibility in terms of what you can do with duty drawbacks. These programs are highly underutilized and can significantly boost your cost recovery for tariffs. And importantly, on April 5th, 2025, CBP issued guidance and confirming that the duty drawback is available for the 10% universal baseline tariffs that took effect on April 5th, 2025.
Michelle, we had a question about bonded warehouses. So just to clarify, if an item is re-exported, there are ways to not have to pay the duties if it was stored in a bonded warehouse. For items that you want to destroy or abandon, you had mentioned that you can't you still have to pay duties, but there is a way, like just to add complexity there is a way to apply to customs for relief in certain circumstances. So it's not totally black and white. So I did just want to clarify that in response to some comments.
So if you go into like bonded warehouse, not the FTZ, so you kind of you have to destroy them within the bonded warehouse for whatever reason. Maybe your products expire, you cannot get used anymore, and you still need to, you owe the duties the day you come into the bonded warehouse. Now you ask, how can I get relief? You apply for drawbacks because your products are destroyed and unused pretty much after they got introduced in the United States. So you can kind of apply for duty drawbacks. FTZ is kind of something that allow that bonded warehouse benefit and duty drawback together into one program, if you think about it to some extent. But yeah, definitely there are ways for you to get the duties back. However, I will say that it's highly, the duty drawbacks are highly unutilized, and people just forget that they actually have they just leave some money on the table. So.
Francesca, there's a question about valuation. I don't know if you wanted to handle that, or it says, I can ask it. If a foreign manufacturer sends an item on consignment, this is going back to the valuation questions. If a foreign manufacturer sends this item on consignment at their cost, and then the importer doesn't assume ownership until they actually sell them, right? Sell the item. What tariff applies, or what value applies that the tariff should be associated with?
So I think there's two questions there, and one of them I actually don't know the answer to. I'd have to look into a little bit. But at the time the good is entered, you're going to have to declare a value. And if you don't have a transaction value because you don't have a transaction, you're going to have to look at one of the other customs methods of valuation. There's computed value, which is based on the cost plus profit overhead. There's deductive value. There's also the fallback method of coming up with something reasonable. So you'd have to come up with a value, and if you don't have a transaction at the time, then it's computed value. That being said, there are, I believe, ways to amend the entry later if there is a change in value. And that's the part where, honestly, I would have to look into that because I don't recollect off the top of my head how to do that one.
Yeah, so that's right. And there's the other valuation methodology. There's also transaction value of similar goods or similar merchandise, which could apply here as well. And then if you were going to change it, you would just, upon entry, you would put the value recon. You do the value reconciliation process, which gives you a certain period of time to go back and change the value of the good. But like you said, Francesca, there has to be a value associated with the good upon entry. You can't come in as zero, right? Sorry, Michelle, I cut off. Do you have anything else about the duty drawback, or?
I wanted to make sure one thing was clear that I thought Michelle said, but I just reiterate.
I was reading the question as well. So the question is, did Michelle say the duties are owed on goods that in bonded warehouse and exported? If the goods weren't entered for consumption, I did not think duties were owed, and exporting was an action. Exporting was an option. So the answer, unfortunately, it is the duties were owed. You just don't need to pay it until you are taking the goods out for consumption. So you're keeping the goods there for 5 years. The reason that why I say when you get into the bonded warehouse, duties were owed, because you will need to file an entry summary when you apply to admit into the bonded warehouse. So the duties kind of were owed, and this is the difference between major difference between FTZ and the bonded warehouse. The bonded warehouse is just somewhere you can consider as somewhere that you can park your goods there temporarily before you pay the actual money from your pocket. But theoretically, those duties were owed, like because you have to file entry. The custom already know they are entering into the U.S. custom territory because bonded warehouse is considered a U.S. custom territory, unlike the FTZ. So I hope that clarifies the question.
Well, I do think from a practical point of view, though, if you export them without ever entering them for consumption, you can get abatement of the duties.
You could apply for the duty drawback. Giving you another example, for example, a lot of companies' goods coming in and stay in the bonded warehouse, and then later got refused for entry by FDA or another agency. So from customs point of view, they are okay to be out. But from the FDA or other agencies, they might consider, no, I don't want this product to be entered into the US. I want it to get out. Do you need to pay the duty? You still need to pay the duties. And sometimes even if there are times that products are got seized by customs and destroyed right there, do you need to pay duties? Yes, you need to pay duties. But can you apply for a duty drawback? I think the question is yes. You can consider working with some counsel and getting the duties that you have paid up if you don't ask for them, or if you have to ask for them right away, because of the refusal of entry by the other regulatory agencies' actions, or a destruction by custom because of some seizure. Now there is some caveat. If the products are never legal and whatnot, you will have to look into whether that's duty drawbacks are allowed. But they're just, unfortunately, bonded warehouse is considered custom custom territory for duty payment purposes.
So one thing I wanted to say about drawback before we move on, though, is I think Michelle made the point about manufacturing drawback. It doesn't have to be a situation where you're the importer and the exporter. Importers, exporters can work together to come up with a appropriately approved drawback process where they can have all the documentation and they share it, so that even if one party is the one that pays the duty, another party can be the exporter and file for drawback, and then on a commercial basis, you would work out, who gets how much of the money. So it doesn't have to be a situation where you're handling all of it yourself. Just to make that clear.
Yeah, correct. Assuming you have a proper documentation evidencing the transfer of goods between the chain, the producer, you don't have to be the importer to apply for the manufacturing drawback.
Okay. Now I think we're ready to go on, Samir.
Yeah, sure. So we wanted to just finish our discussion today just on a general discussion regarding some operational restructuring ideas. Again, like I said at the outset, this is much more difficult in an uncertain environment when we're sort of not sure exactly how the tariffs are gonna play out. It was almost easier during the first term when we knew that sort of China was the main focus and not necessarily every other country in the world. So, but this idea of onshoring and nearshoring, there is a sense amongst the companies who are looking at different avenues of supply chain, when you're looking at sort of up and down your supply chain, to focus on sort of U.S. investments and where there are areas that you can focus on sort of and the priorities of the administration, such as energy, national security, defense, semiconductors, for example. There may be opportunities for U.S. investment where not only will you be able to sort of take advantage of investment opportunities in the U.S., but the government procurement programs that could be coming in place to allow for better investment, and also looking at different supply chain mechanisms where you can change your supply chain and alternative sources, and looking at ways to manufacture goods in other countries and taking advantage of substantial transformation or country of origin analyses. And so this is a similar idea to the USMCA issue that we were talking about previously, as well as even the Chapter 98. We have helped a number of companies and clients look at alternative sources and looking at alternative ways to set up manufacturing in a different country such that the country of origin of the good changes. For example, if right now you have a manufacturing facility in China where you're using goods that are in China, you can still get raw materials from China, have them exported to a different country, India, Vietnam, Bangladesh, whatever, have some further processing in those countries such that the country of origin is therefore changed into a good of that second country rather than China, and then imported into the United States. It's a little bit harder right now when we're not sure what the percentages are going to be in those other countries, but assuming that China is still going to be the sort of largest percentage of which it is right now, like we discussed at the outset, the baseline for China is 30% plus the 25% Section 301, so basically 55%, whereas the other countries are 10 or maybe 25 for Canada and Mexico. Looking at ways to change the substantial transformation of those goods in a different country could help you sort of save on various costs. Same thing with assembly services. Assembly services is a different idea where the assembly services are taking place, let's say, in the US rather than in a foreign country. And we've helped clients do this, where you're importing all the raw materials or importing the components, which are at a much lower cost than the final good. You import the components into the United States, have the assembly services and pay for the assembly services in the United States, and therefore you're not paying tariffs on the final good, but rather on the various components that are coming into the United States. That's one area. That's another sort of area. And finally, and just given the amount of time we have left, one of the main focus that we've been doing over the last few months is looking at various agreements and contracts with your suppliers, with your customers, seeing if there's ways to sort of mitigate the tariffs or really transfer the risk of tariffs onto a third party. Some of them, they work in various ways. Some of them do work better than others. I don't think that, so like force majeure is one area that constantly comes up. There are situations where companies have tried to use force majeure provisions in order to transfer the tariffs onto another party. I don't know if it's, the court cases and cases that we've seen have been relatively clear when force majeure has been used. It really, and all of these, the changed circumstances, the tax provisions, it really comes down to the understanding of the parties, how the agreement was structured, and really the contractual intent, and to see whether or not tariffs were supposed to be covered under these force majeure provisions or under the changed circumstances provisions, or even the tax provisions. Some of the tax provisions have words like duties in them, but whether or not that really includes tariffs comes down to whether or not the parties understood them to include tariffs. It's difficult to look retroactively at that, but prospectively and looking in the future, having those provisions spelled out in detail and understanding who is bearing the burden of the risk of those tariffs in the future is even more important. We have seen a number of tariff sharing agreements that are starting to get put in place, something along the lines of, depending on what the tariff numbers are, 50% will be borne by the buyer, 50% by the seller, or some other amount, depending on what the negotiation is between the parties. We've seen a lot of that being put in place. Also, changing of Incoterms to transfer the risk of loss or title could change the ability for you to have to pay tariffs or not have to pay tariffs. And just in the interest of time, I'm saying, Francesca or Michelle, is there anything you guys want to talk about, sort of generally speaking, related to these types of ideas or other things as a final sort of point?
Sure. I just want to circle back to the idea that the tariffs are costing companies a lot of money, so we're looking for ways to mitigate them. There are ways, but you just want to be careful and methodical about any that you're exploring, because you don't want to be caught up in the cycle of False Claims Act litigation, CBP audit, or customs fraud enforcement. And these things are hard. I mean, it's kind of hard to know whether something is a legitimate or non-legitimate way to change your customs value.
Yep. Michelle, any final thoughts? I think Michelle's looking at the question in the box.
I think we might need to answer those after the call.
Yeah, we need to talk more about the bonded warehouse. I think that there might be some confusion when I say the duties were owed. When if you don't take out your product from the bonded warehouse, nobody is coming up to you and asking, "Hey, where's my money?" So you were not owed at that point. But should we say, well, once you want to pay the duties but then but you already filed your entry summary at that point, so we can consider that duties already owed at that theoretical way. Now, Francesca also pointed out that when the products are out and exported or destroyed under CBP supervision, the warehouse user's liability under the warehouse bond is generally canceled, and that is true too. But it could be it's theoretically a little bit different when we talk about liability and duty. So I don't want everyone to get confused. If there are more questions on this, I'm happy to address that after the webinar.
Yeah, I think that's great. And
Time
so
for people are demanding it.
yeah, a lot of issues here, a lot of questions surrounding a lot of these. I hope you all enjoyed today's webinar. Thanks again for attending today's webinar. Quick plug, if you're not currently receiving updates and invitations, please go to Thompson Hine's website and register. We also have a Thompson Hine Smart Trade blog, which I encourage you all to sign up for. It has a lot. We put a lot of time and effort into the blog and putting out information related to all international trade issues, obviously tariff and tariff mitigation strategies for the foremost over the last 3 or 4 months. But thanks again. Really appreciate your time and spending it with us. And please enjoy the rest of your day. Thanks so much.